What's up guys, Jake here. In this video, I'm going to show you exactly how you can make close to a 20% return on your investments in your traditional or Roth IRA. Most people might be saying this is too good to be true. They're just holding a target date fund or a mutual fund or an index fund. But with a little active management on your side, it is possible to double your returns in your retirement account. And you can do this by selling options. Now, before you click out of the video, just hear me out. I said selling options, not trading options. I wouldn't recommend trading. Now, if you're not familiar with trading options, there are two kinds. There are calls and puts, and you can buy or sell them. In a retirement account, this is supposed to be your nest egg, your future money that you will be retiring on. So I would never recommend buying calls or buying puts. This is very high risk. You can lose 100% of the premium you are paying for those contracts. However, the other side of the coin, selling cash secured puts or selling covered calls, these are very conservative forms of options trading, and they lead to consistent income over time. To learn about options in great detail, check out my playlist. I have now 27 videos that I've made about trading options. However, the videos you should specifically watch are Covered Calls Explained, and then I do live examples on Charles Schwab, Fidelity, and Vanguard. I know a lot of people's Roth IRAs are with one of these three companies. So I do full examples, how to get into one and how to get out of one. And potentially, you didn't know this. You didn't know that you could apply for approval to trade options in your IRA, which is possible. Here's a screenshot with my broker, Charles Schwab. And if you want to sell covered calls in your Roth IRA, you only need to be approved for level 0. So this is selling covered calls, and covered puts is cash secured puts. And this is for income and capital preservation. So if you don't want to do any speculation on level 1 or 2, you don't have to. And why do people love covered calls? Well, let's just go through the basics real quick. First thing you need to know, in order to write a contract and sell it, you need to have 100 shares of a stock or ETF. And you're selling to open, so you're the one generating the contract, and somebody else on the other end is paying you a premium by buying that contract from you. Now, this contract is giving you an obligation, should the buyer want to exercise, to sell your shares of your stock or ETF to that person at a certain price at a future date. But as the seller of a covered call, you choose the expiration and you choose the strike price. So you literally cannot lose money selling covered calls if done correctly. There are only two outcomes when selling covered calls. One, the stock or ETF does not go above the strike price you agreed upon with the buyer of the contract. So you keep your stock or ETF and you keep the premium you were paid, the premium the buyer paid you for the contract. Or, worst case scenario, the share price of the stock or ETF goes above the strike price, the contract is in the money, you're going to get exercised, meaning the buyer is going to pay you the agreed upon strike price for the 100 shares of stock or ETF. So you're going to be paid what you agreed to sell your stock for, and you collect the premium for the contract. So let's get to an example and break down the math, exactly what you can earn selling covered calls in your Roth IRA. This is my Roth IRA, and I've only been contributing to it for 3 years. So I maxed it out the previous 3 years, so I've put in $18,000, and I'm currently at 23. So it's not a very large account yet. And I am currently holding 100 shares of Vanguard's total stock market index ETF. This is VTI. This is a very good index fund to just hold long term anyways. However, I want to hold 100 shares of SPY. But what is the problem here? First of all is, if you're going to sell covered calls, I recommend selling it on an index, not an individual stock. With an individual company, they could have bad news, something unexpected could happen, companies go bankrupt. So if you want to minimize risk, then buy and hold an index, either the S&P 500 or the Russell 2000 or total stock market index, or even the NASDAQ, which is QQQ. And the ETF that I recommend to people on my channel is State Street's SPY. The expense ratio is about 0.1%, a little bit higher than Vanguard, but the reason why this ETF is so amazing is because it is the most traded on options ETF or stock in the world. So this has lots of volume, lots of liquidity. You'll have no problems getting in and out of contracts, and the bid-ask spread will be very small. But the problem with State Street's SPY is 100 shares costs $43,134. I do not have $43,000 in my account, which is why I'm currently trading options or selling covered calls on Vanguard's VTI. However, once I have $43,000 in my Roth IRA, I will switch to SPY. You can additionally, if you have money in a Roth 401k or a traditional 401k, you can transfer that money over to your equivalent Roth IRA or traditional IRA in order to boost the amount in your account. So let's just get into my account and then I'll show you exactly what an option chain looks like. So here it is, and we're gonna do an example for SPY because I wish I had $43,000. And if I click over here, obviously your broker is gonna be different. Go on YouTube, watch tutorial, how to get to the option chain with your broker. But on Charles Schwab, there's a drop-down menu and I can click here on option chain. Now, first thing we have to do is choose an expiration date, and for many reasons, I recommend going about 1 month out. There's something called theta decay, which wastes away the value of contracts, and it accelerates, especially in the last 2 months, as you get closer to an expiration date. So I am looking at this option chain on Saturday, July 17th, so we're going to choose an expiration date in August, about 1 month out. And the third Friday of every month is the monthly contracts, and they always have usually the most volume in a month. So I'm going to choose an expiration date of August 20th, which is 34 days in the future. The next thing you have to do is choose a strike price. What price are you willing to sell your 100 shares of SPY to the buyer of the call contract? And something you're going to want to reference is the Greeks. And the only Greek you really need to know is delta. So on Charles Schwab, I can go to this drop-down menu and then select Greeks in order to find delta. And the sweet spot when choosing a delta is about 30%. Roughly, this means, according to the Black-Scholes formula, that 70% of the time your calls will not, the covered calls you sold will not be in the money, you won't be exercised and have your shares called away, but 30% of the time you will. This gives you a good probability of a nice premium while not always being exercised on. But being exercised on is nothing to fear. I'll explain that in a minute. So under calls for delta, I'm seeing 0.41. That's 41%. So I actually don't see 30%, so I need to see more strike prices. So if we click here on 16, I can scroll down and here we go. 31% for a strike price of 439. So the current share price of SPY is 431, and I'm choosing the strike price of 439. So if in 34 days, SPY, the share price, gets above 439, I'll be exercised on. The buyer of this covered call will pay me $439 a share and take my 100 shares away from me. Let's go over the math, how to do that in a second. But what you do is you just click here, select, and then you're going to want to click on trade. So going back to the top, it is built in order for me. So expiration date of August 20th with a strike price of 439. It's giving me a C. It now wants to know, am I buying this or am I selling this? So you need to click on sell to open and quantity of 1. It's 1 contract. 100 shares equals 1 contract. Now the buyers are bidding $3.19 a share. But times 100, it's a total premium that you're going to be paid in cash today of $319. And the sellers are asking $321. Let's just go with the buyer's bid price. It's only a difference of $2. So in order to execute this, we would go on trade, and then you can do a limit order or a market order and get it filled at $319. So what did we just do? How much did we just make? I'm going to show you the math, and we'll go ahead and assume the worst case scenario, that the S&P 500 is having an amazing month. the shares of SPY are skyrocketing to the moon, you get exercised on. Your 100 shares are going to be called away. What this means is you're going to be paid the strike price per share. So the current share price of your 100 shares is $431, and you're going to be paid by the buyer $439. The buyer would only do this if the shares were worth more than $439. But this is capital appreciation. You're making money from the sale of your 100 shares. So you can subtract the difference, $7.66 a share, multiply by your 100 shares, you're going to make in 34 days $766 in capital appreciation on your 100 shares when selling it to the buyer. But of course, you were also paid the premium for the contract. So somebody paid you to buy your shares for more than what they were worth when you sold the covered call. Plus, they paid you for the contract. So you have to add these two together. $766 for capital appreciation, $319 for the premium. So in 34 days, you made $1,085. Once again, is that a good rate of return? Well, let's figure out what the equivalent APY is. So if the collateral we're putting up, we're tying up for this 34 days is the 100 shares, that's $43,134. So we made $1,085 on $4,134. You can then divide that by 34, multiply it by 365 to get your equivalent annual percent yield, and you're earning 27% yearly equivalent on your money over a 34-day period by selling this covered call. And this is the worst case scenario from selling the covered call. You got exercised on. Your shares technically were worth more in value past the strike price, but you don't care. You basically capped how much you could make by picking that strike price, by selling that covered call. But 27% APY over a 34-day period, I'll take that any day. Now the problem here might be you have to buy back your 100 shares of SPY in order to sell another covered call on it. Now this is a problem with selling covered calls. However, you should be not exercised on more than you're being exercised on. So you're not going to average 27% for the entire year every 34-day period, but you will be doing better than just holding the index. And let's talk about that. What is the risk of selling covered calls? And the risk is holding the index. If you're comfortable holding an S&P 500 index fund, then you should also be comfortable selling those shares for a profit, collecting a premium by selling covered calls. Now, the S&P 500 index fund is very volatile. It can go down in a year 10, 20, or even 30%. There are years where this has happened. However, if you're selling covered calls while the S&P 500 index is going down, then you're lowering your cost basis for those shares. As the index falls and you sell covered calls, you're collecting premium on contracts that will never be exercised. You're not going to lose your shares. Yes, your shares are going down in value, but if you're comfortable holding the index anyways long term, like I said, collecting that premium from selling covered calls lowers your cost basis and earns you a higher return over time. The point I'm trying to make in this video is that by selling cash secured puts or covered calls in your retirement account, you can greatly boost your returns over time. Look at a retirement account calculator and change that annual percent yield from 7, 8, 9% to 16, 17, 18%. This can easily be achieved by selling covered calls on a safe asset like an index fund over decades potentially. Now, yes, you're going to have to check your account once or twice a month. Some people really enjoy the hands-off, automated, don't have to think about it, set it and forget it. However, if you are someone who wants to put in just a little bit of extra time in a month over a 10, 20, 30-year investment period, you can massively increase how much money you'll have for retirement. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, check out that playlist on trading options to learn more if you have questions or are confused. Otherwise, leave me a comment. I will help you if I can. Always happy to help. Till the next video, take care.